Hello, my name is Connie and I'm from MortgageUnderwriters.com. Every day I get people that send me emails and they want to know, well, based on this situation, which loan is best for me? So today we're going to cover the main topics that you need to consider, and the loan types that we're going to look at are the conventional, USDA guaranteed, USDA direct, FHA, and VA. The things that you need to consider when deciding what loan type is best for you are: number one, the loan type limitations, the down payment required, your credit history and credit score, interest rate, and mortgage insurance. Conventional loans. The biggest limitation to a conventional loan today is the underwriting process. And I know this is crazy, but on a conventional loan, the underwriters have gotten so ultra conservative, it just is outlandish, the documentation that they're requiring now. And of course this is because of the mortgage meltdown and all the mortgage scandals that went on. So now they've gone 100% conservative. I see people with excellent credit, good down payments being turned down all the time. They're going to ask you for documentation that you probably don't even have. If you can get through that hoop, obviously it's a good program. USDA guaranteed loans and the USDA direct loan both have the same issues. Number one, the home that you're purchasing needs to be located in a rural area, and that is typically defined by the population, which should be less than 10,000. Then the next limitation is your income. They calculate your annual household income, which is different than your repayment income, and they lump it together. And for the guaranteed loan, it needs to be less than 115% of the median income for that county, and the direct loan, it needs to be less than 80% of the median income for that county. So you have the location of the home and your income limits. With an FHA loan, the biggest issue are appraisals. If you're looking at a house that has issues or is extremely unusual, it's probably better not to go with an FHA loan. With a VA loan, you have to be a veteran. Their appraisals are very strict also, but not nearly as bad as the FHA. How much down payment do you have? For a conventional loan, you need 5% or more. How much you need is determined by your credit score. USDA guaranteed and USDA direct do not require a down payment. FHA requires 3.5% down. If you have credit score or credit history issues, they will require more. A VA loan requires no money down. Your credit history and credit score. On a conventional loan, you need to have a score greater than 640. It will also impact your interest rate. USDA guaranteed loan, if your score is less than 640, it will require a manual underwrite by USDA. The USDA direct loan is a little more complicated because basically they say that they don't look at credit scores. However, if your credit score is above 640 and you have little dings on your credit, they can give you a waiver. If your credit score is less than 640, they're pretty strict about late payments, collections, and judgments. This is a concept that you need to understand. FHA and VA have what they call their minimum underwriting guidelines. Then you have your lender, and they have their underwriting guidelines. Now, a lender's guidelines typically are tougher than VA or FHA because it's all based on risk. So FHA for years did not even mention credit score. It was all credit history. Last year they came out, in 2011, they changed that, and they came out with a minimum credit score requirement. If your credit score is less than 580, you're required to put 20% down. Reality is that if your credit score is less than 620, you're not going to find a lender that will do an FHA loan with you at all. Understand that lenders' guidelines trump FHA, and that's okay with FHA. It's the lender that has to measure the risk. So basically, I would say if your score is less than 620, forget it. And it's kind of the same way with VA. It's determined by the lender. Your interest rates, on a conventional interest rate, it's very simple. It's based on credit score and your down payment. Again, they're looking at risk factors, and they measure that by your credit score. If your credit score is high, your interest rate will be low. If you put a down payment, less risk, lower interest rate. USDA guaranteed doesn't actually recommend interest rates, but they do cap it. So the lender has two choices. Understand, it's the lender that is at risk here, not USDA guaranteed, not USDA. So they have two choices. One, the interest rate max can be 60 basis points over the Fannie Mae 90-day AA interest rate, or whatever the lender has posted for the VA rate. So USDA caps it so that you can't be taken advantage of by the lender. Now the USDA direct loan is very, very complicated because this is a loan directly from the government, taxpayer money, and it is subsidized. The payments are subsidized. So with a direct loan, the effective interest rate, if you qualify for the subsidy, could be as little as 1%. But even if you don't qualify for the subsidy, the interest rates are so low, they're probably lower than the lowest conventional rate. So, as far as interest rate, it's not an issue. Now, FHA, again, it's determined by the lender, and it's based on your credit score and down payment. And the same with VA. It's determined by the lender. Mortgage insurance is a very, very expensive thing, and after the mortgage crisis that we've just recently gone through, it's gotten more expensive. If you can avoid it, you should. Conventional loans all require mortgage insurance. USDA guaranteed does not require mortgage insurance. However, they do have fees that you have to be paid. They have an upfront funding fee of 2% of the loan amount, and that can be financed into the loan, which is a good thing. But just in October of 2011, they have added a 0.3% annual fee based on the unpaid principal balance. Now this is paid by the lender at the end of the year, and you know the lender is going to charge it to you, and it'll be included in your escrow. But remember, this is not insurance. This is monies that go to USDA to cover their operating expenses. The USDA direct loan does not have mortgage insurance. FHA does. VA does not have mortgage insurance. However, it does have an upfront funding fee, and this funding fee may be financed into the loan also. Now, the amount of the funding fee varies based on the type of military service that you did and whether it's your first VA loan or your second VA loan. But basically, if it's your first loan and you were active duty, it's about 2.15%. If you're a disabled veteran, it's possible that you can get that waived. Once you determine what loan you think would fit your needs the best, I want to ask you to do two more things. First of all, I want you to be smart about this. I want you to buy less than what you can afford. And by that I mean less than what the lender tells you can afford, because they're going to drive you all the way up to their max. But especially if you're a first-time home buyer, you really don't know how much it's going to cost you to maintain that home. If you need a new roof or the water heater goes out, you can't call the landlord. I mean, you have to take care of these things. In addition to that, you have to pay the annual taxes. City, sometimes even county, or always county, and sometimes even city. And then you have your homeowner's insurance, which has really gotten expensive. So please, don't go to the maximum limit that the bank tells you. You come down from that and determine what you can really afford. And then the next thing that you should seriously think about is, instead of financing it for 30 years, try to finance it for 15 or 20 years. You will save yourself thousands and thousands of dollars if you can do that. I recommend that you do your research before you even apply for a loan. Every mortgage is different, and the guidelines, are different, and they're very detailed. Here are 5 websites that go over in detail what the mortgage guidelines are. So you should look at them, read them, determine what you think is best, because you don't want to apply for a loan, put out all that money for inspections, appraisals, all this, to be turned down 2 days before the loan's supposed to close, because you won't get your money back. So do your research first. These are great websites. When you go to these websites, if you have any questions that aren't covered there, all you'll have to do is send us an email from that website, and we'll be happy to answer the questions for you, and we'll even show you the link to the government website that shows you the guidelines. So please do your research, and yes, go buy a house. The interest rates will never be this low again.